Welcome to The Edge by MGR with your host, David Gill.
Hey everybody, welcome to The Edge podcast by MGR. Your host, David Gill here. Hope everybody's having a fantastic week. As always, I certainly am. Really excited, actually just was talking to a couple potential interview guests that will hopefully be on either next week or the following week. I know I've been promising some great guests in the past couple weeks, and finally they are lining up. Just kind of, have to, accommodate for people's travel schedules, and these are busy executives and successful people, so I have to be respectful of their time. But anyways, very excited for that. Just wanted to give a quick update because I know I've been teasing interviews. But yeah, one of them will be the CMO of a $100 million plus company, organization. And anyways, that's all the details I can say now, but definitely am looking forward to those interviews coming soon. Nonetheless, got a lot of good response on my last episode about Apple, the strategy of Apple, the Apple Watch, the iPhone X or XR, and their strategy for moving into India and expanding revenue. How do you grow a $1 trillion company when you're already a $1 trillion company? How do you keep growing? Well, I gave my analysis of Apple's strategy to do just that. So give it a listen if you have not already. Just scroll right back in your podcast feed. Anyways, today we are talking about the easy money era in venture capital and why I think that it will soon end. And I'm not, some bear or saying tech startups are overvalued, we're in a huge bubble. No, I'm just going to kind of give you a few reasons why I would not expect this to last much longer. Very much a numbers-based analysis. But anyways, let's get into it.
You ain't got no money, I ain't got no time. All these faces looking funny when I'm driving by.
So at the moment, we are experiencing the biggest amount of capital in the venture capital markets and startup land ever. There has never been this much money, even in the dot-com bubble. And the ironic thing is a lot of this money is going to software companies, and we're in the information age. One of the brilliant things about the software age is that any kid or group of people in their garage or bedroom or whatever with very little money, just time, could create the next big thing. That was the whole promise. That was the whole big deal. That didn't really take much, and it doesn't really take much to create a product. You can go, if you're a developer, on your afternoons or weeknights and weekends and develop a product on the side and with very little money and become successful, or at least get some form of product or business out there with very little money. But now, and the reason I say it's ironic is that the whole promise was that it didn't take money, but now there's more money flowing towards software companies and startups than ever before. And, the question is, do they necessarily need this money? Do you even want this money if you're a founder? And I'll get into that a little later. But, first I wanted to talk a little bit about why. Why is there so much money right now? What has changed from, 10 years ago to now that there is $100 billion or more this year that will be invested into venture capital, when just maybe 5-6 years ago there was not even 30 billion a year, and now that number is over 100 billion. So what has changed? Well, a couple things. So if you look at the last decade, the 2000 to 2010, and then, or kind of right, not exactly lining up, but basically the decade of between the dot-com bubble and the housing collapse in 2008, 2009, and then the decade now, basically the 2009 to now, what has changed? Well, in the previous decade, in that previous little cycle, interest rates were much higher, and there was very many places to get a 4 to 5% return with relatively low risk, right? You could go open a savings account and get 4% return. You could get CDs, like a 12, 18 month, 24 month CD at 5%. You know, these days, those CDs go for about 2.5%, and that's on the high end, and that's now with interest rates rising. But for a decade, we've had really, really low interest rates, if not zero interest rates or even negative interest rates in other places outside of the U.S. And so obviously, you know, that's a stark difference from being able to open a savings account and get 4 to 5%. And so with this chase for yields of investors, it's much more difficult to find a 5% yield or a 6% yield. Now, and not to mention that this is the previous decade there was a combination of the dot-com bubble bursting and scaring away investors from tech, and there was a macroeconomic climate where you could get 5% returns with very little risk. That made it very difficult for startups to raise money. But now investors are enamored by stories of startup riches, and that compounded by the fact that, you know, achieving even a 7% yield right now is actually quite difficult with the same risk tolerance that you could have 10 years ago or more than 10 years ago. You just cannot find CDs or low risk bonds that are going to give you much more than a few percentage points. You're going to need to increase your risk tolerance, and that's what investors have done. Risk tolerance is now higher than ever because investors have no choice. Either you make no returns or you take the risk. You know, this has changed the very fundamentals of how investors are valuing companies. You know, there's an endless list now of companies that have little to no profits, or in some cases are even losing money, but they have massive valuations because of their growth, right? The market conditions have shifted investment principles, really, you could say, and profits are now secondary so long as top of the line revenue, or you have massive amounts of users. As long as top of the line revenue, user growth, all of that is occurring, then profit is secondary. This was not the case 10 years ago or in the previous cycle. But you know, the question is, what happens when hundreds of billions of dollars are thrown into businesses that don't actually return a positive cash flow? You know, we live in a world of paper millionaires and billionaires, but how often is that, or what is the likelihood that all of that money will materialize? Is this sustainable? Is this the new norm, or is it a bubble? And I don't think it's necessarily a bubble per se. I don't think that, you know, we're going to see some pop, some major crash where all of a sudden no one's investing in tech startups. Definitely not. I don't think that's the case. But I think at some point we will see a slowdown in the amount of money that is flowing into VC's hands. You know, the balance of investor capital and capital needed from founders is skewed it's off balance, right? The scale is definitely skewed towards way more money flowing into founders than what they actually need. And the question is, right, you can only have so much capital because there's only so many new businesses and new ideas that can be created that will bring these massive returns, right? There's only so many Ubers and Twitters and whatever, that there's so much money in the space that there are not enough founders and companies that can give you a return on 100 billion. On 30 billion, yes, there was. On 100 billion, there's just not enough money that can be returned to make it worth investing in VCs at this point. You know, many prominent VCs and angel investors have actually greatly reduced the amount of companies that they're invested in, or many have even left the market entirely. You know, a famous example is Tim Ferriss. He decided to leave. There's lots of Chris Sacca has decreased his amount, and he was a big time investor back just 5-6 years ago. Many investors have very much decreased the amount of investments they're making or left entirely because the market has gotten so saturated with endless capital. It's very easy for startup founders to go and raise capital. And listen, I'm not saying this is necessarily a bad thing, and I'm not blaming founders in the slightest. If you're a founder and you know that it's going to cost you $1 million over the next 2 years to keep your business alive, and you know that you're going to need that money because you have this new prototype or product, or your software is in beta, whatever, and you say, hey, I can go raise money, I can go get $1 million for my company pretty easily, and it will allow us to last another 18 months, 2 years without having to turn a profit. Of course you're going to do it. You have all the incentive in the world. So I'm certainly not blaming founders in the slightest. It's more on the investor side that I think investors are soon going to realize that it's not that easy to get these big returns. The problem with venture capital and startup investing is the complete illiquidity in the markets, right? Because it's so illiquid, it takes so long to get your money out, right? If you're an investor in Uber, there are many investors who still have not been able to cash out from Uber. They have not gone public yet. In most cases, right, you invest in a startup and you exit, either you get bought out or you go IPO. Now, in these days, there's so much money in the market that you actually have these, by the time you get to Series D, Series E, whatever, new investors will buy older investors out, the early angels out, but not in all cases. And so it's a question of how are these guys going to cash out? It's going to take years. It often takes 5 to 10 years before you will ever see your money back if the company is successful, right? Obviously, most startups fail. So if a VC fund isn't returning at the very least 10% IRR, or basically an annual rate of return, it's not worth it to invest in venture capital if you're not getting at least 10%. And really, some say it should be 12%. 12% is basically, if you have a 10-year fund, which is pretty common, that at the end of the 10 years, 12% annual, they will have tripled your money. So for the risk of saying, I'm going to give you this money and I'm not going to see it for 10 years, you're going to triple it. But at least 10%, that gets you to about a 2.5x return, not exactly 3x, but at least you're going to get, a 10% annual return, and that's better than you can expect from general public markets normally. Obviously, it depends. If you're in a bull cycle, we've had years with the S&P and going up 15%, whatever. But that's abnormal. That's not the norm. So you need at least a 10% for the risk and the illiquidity. The problem is, because you can go elsewhere and get 6 to 8%. If you bought the S&P, right, you can get on average about a 7% annual return, and that's very liquid. You can sell your S&P, your ETF at any time. If you're investing in VC, you're not going to see that money for 10 years. So, after this 2009 to 2013 era, right, in that era, there was a massive boom of multi-billion-dollar companies and insane venture capital yearly returns, right? The median yearly return back in this era was about 20%. That means your average VC firm, not the top ones, average was getting about 10%. And even some years, the bottom quartile, right? The bottom quarter, the worst of the VC firms that are just not that good, were still getting a 10% annual return, which is incredible, right? That the worst of the worst were still getting 10%. So, and in this period, that kind of 4 or 5 year period, you had Uber and Airbnb and Instagram and Twitter and Dropbox and Pinterest and just dozens of heavy hitters. You hear these stories of riches and companies going from zero and seed stage to worth billions in just 3 years. I mean, that's insane. That's not normal. That's incredibly rare that you have a company go from zero to $1 billion or more in just a few years. And again, at the same time, remember, this is the post-recession years, or in the middle of and post-recession years, where interest rates were zero or negative globally. This kind of created a perfect storm for money to flow towards venture capital. Money is always going to flow to where it can compound most, where the returns are. And all of the returns at this time were in VC. But the thing is, now there's too much money. And this is how I know. So in the period, in that 5-year period that I said, that spawned all those companies and had 20% annual returns, which is insane. In that 5-year period, there was, or I should say, in the last 2 years, from 2017 through this year, through the end of 2018, there will be more money put into startups than there was in that 5-year period combined. And I think a lot of these investors are failing to realize that one of the reasons for that 5-year growth period was because of a shift in technology, right? One of the reasons was because of the iPhone and the overall shift from desktop to mobile. Most of these companies that grew from that era were based on being mobile first, and that was when being mobile first was unheard of. Uber, Instagram, Twitter, all these companies, they were never desktop companies. They were always companies that took advantage of people now having a computer in their pocket, or in the case of Instagram, everyone having a camera in their pocket at all times. Before that was not the case. And so there was a major technological shift, and many companies were able to be born out of that shift. Right now, there is no such major shift, especially not on the consumer side. You could argue that on the B2B front, AI is kind of that shift. Everyone's switching from basic software to now advanced AI. But even then, I think that's a bit of a stretch. I wouldn't compare it quite to the shift from desktop to mobile. So now you have more money than ever pouring into companies who do not have the advantage of being first to a new technological trend, because that was really the advantage of those companies. You can still start another Instagram or Uber or Twitter, but good luck competing, because it's kind of too late. It's very, very difficult to compete with them at this point. But because they had partly first mover advantage on this new technological trend, they were able to grow really quickly because they were the only offerings available at that time, and they had a fantastic new product that had never existed before. And listen, I've talked about how I think the new trend, when we will see another shift like that again, is when AR hardware finally takes off. The software, I think we will see another boom of augmented reality apps explode, but the hardware needs to be there first. Just like for all of the mobile apps to explode, you needed the iPhone and Android first. So once the hardware is there, then you will see the software explode. But we're not there yet. That's still a few years away. And until then, returns will remain low, and many companies who should probably only be given a few $100,000 to start will be given millions. I mean, just look at how Series A rounds have been going recently. I mean, they've gotten ridiculous because it's so hard to find companies that can get traction, that if you're the classic case right now is the B2B SaaS companies. There are so many B2B SaaS companies. It's mind-boggling. And it's so hard to gain traction because there's only so many problems and ideas and improvements that can be made that haven't necessarily already been made yet with the technology that's available. And so anytime one of these companies is able to show, hey, we have, $2 million in revenue, all of a sudden they're able to go out and raise money at a $50 million valuation when they're only doing $2 million in revenue. I mean, insane multiples like that did not exist 10 years ago, 15 years ago. And you've got companies like, just last week, a company called Airware. They were a drone analytics company. They raised $70 million 24 months ago. They've raised almost $120 million in their 5-6 year tenure, and they went completely out of business. Gone. They don't exist anymore. $120 million evaporated. Why? Because they were able to show a little bit of traction, and all of a sudden VC money, VCs were throwing money at them, and then all of a sudden they realized, oh, this isn't a real business. Drone analytics. I don't know. How many drones do you see, right? It was kind of there was a drone trend, but I don't see that many drones, and especially I don't see enough of a demand for a drone analytics company to raise $120 million. And well, clearly there was not enough demand because now they are out of business. Or even more recently, just a couple weeks ago, there's a new mobile video company that was, in this case, the reason why they were able to raise so much money is because it was Jeff Katzenberg and Meg Whitman. Meg Whitman's the ex-CEO of HP, and Jeff Katzenberg was a Disney exec for many years. This is a company that has 9 employees. They have these big names, but they have 9 employees, and their seed was $1 billion. $1 billion seed stage. Have you ever heard of that in your life? And listen, they're brand new. I wish them all the best. I'm not, hoping for their failure in any way, but they're creating what they're doing is a mobile video platform. They want to compete, right? If you saw IGTV, Instagram's new app come out that has not been doing very well, and they want to compete with kind of creating a similar app to that and also compete with YouTube. But they're starting with $1 billion. That's a big bet on an idea, because that's all it is. It's an idea. It's, hey, we want to make vertical mobile first content, video content. Okay, good idea, but is that worth $1 billion? Have we gotten to the point where an idea is worth $1 billion? I don't know. Obviously, they're going to use a lot of that money to go out and license content, but nonetheless, there is so much money in the space, and you really just have to look at, as I said, the returns, because money goes where the returns are. And now that interest rates are rising, now I don't know how long they will stay at the higher levels. This is not a macroeconomic discussion by any means. But I think the problem is that a lot of people who are moving their money into VC land now are going to quickly realize that the easy money, quote unquote easy money, there's no such thing, but quote unquote easy money has already been made. And that venture capital IRR right now is only at about 6 to 8%. At 6 to 8% annual returns, you can get that in a lot of places where you don't have to have your money locked up for 10 years, right? You can get that in public markets ideally. And at least, you can sell at any moment if you want to. If there was an economic downfall and your money is in venture capital, it's gone. You're not getting that money back. There's just, when you have this illiquidity, you need higher returns. And when you're only getting 6 to 8% on a 10-year illiquid investment, I just don't think that it's reasonable. And I think that many of the, and again, I think it's going to take a couple more years to slow down. I think next year will probably be the peak, and then we'll see investors slowly start moving out of VC investments. Quite simply because, as I said, because of this long time horizon, it's going to take a few years for all of the hundreds of billions that have been invested from 2016, 17, 18 to kind of feel the pain a little bit and say, oh, shoot, my money's locked up, I can't touch it, and I'm only getting a 6% annual return. This sucks. So less money will be moved in. Obviously, the money that's committed is already committed. But I think we will see a slowdown for all of the reasons I've given. Again, I don't think we'll see a bubble, a pop. I don't think we'll see anything like the dot-com bubble, but I think we will see a gradual slowdown over time. I think that right now companies are being overvalued. There is too much money in VC. There's just not, the founders don't need this much money. You don't need $3 million to start a software company. You need a couple $100,000 so you can pay yourself, pay a couple engineers, and give yourself 18 months to see if this product works. And if it doesn't in 18 months, 2 years, then it probably is not going to work out, right? Especially in the B2B space where we've seen so much investment. You don't need a team of 15 people and a few $1 million in the bank to start a basic software company. So that's kind of my thoughts on it. And again, I'm not trying to be bearish or bullish. I'm just giving my general assessment and why I really think that it will go down over time. But in the meantime, if you're a startup or a founder, go raise that money, because I don't think that money is going to be there 2-3 years from now. And I think 2018, 2019, this is the time to be raising money, because if you can't raise money now, then good luck in a few years. All right, before we go any further, let's take a quick break. So the real question is, how do companies drive real, meaningful growth, unlike the fake growth in VC land right now? And how can you grow your company? Well, you've come to the right place. MGR has worked with hundreds of businesses to do just that. We're a full-service marketing agency, and by full service, I really mean it. From managing your ad creative to diving deep on your business strategy or even building out entire web platforms, MGR does whatever it takes to help your company grow. If you want to take your business to the next level, that is what we do. If you want to get in contact with us, you can email me personally, david@mgragency.com. send me a simple one-liner, listen to your podcast, interested in working with you, or you can send me many paragraphs explaining in detail exactly what your company needs, what you need help with to get to the next level, and I promise that we will get back to you very quickly either way. One-liner or full trilogy, I promise we'll get back to you. Anyways, let's get into some news.
It's time for the news.
So there was not a ton of news in the past couple days, so I decided I'm going to do a bit of an augmented reality update, an AR update on things that are going on in that space. So first of all, Microsoft is deploying HoloLens, their own AR device, into the real world in a couple weeks. It's working with Chevron on some of their work sites. The workers are going to be wearing the goggles to try and navigate and identify areas with faulty infrastructure and systems that need repair. So this is a B2B example of AR being used in the workplace. We'll see how that goes. Obviously, it's very much in a trial run right now. Also, Mozilla, the creators of Firefox, are creating have created Firefox Reality, which is their first AR web browser. It's still in the early stages, but it allows you to do a couple unique things. You can, if you want to Google it, there's some videos of it, but it allows you to do a couple unique things that are not possible without AR. And one example of that is like if you are cooking, for example, and you want to make some dish, if you're wearing the glasses, you can pop out multiple windows in front of you and kind of resize them how you want. And one can be playing a video of a person making the thing or giving you instructions on how to make whatever dish you're making. And on the left, you can have a little pop out with a web page that has all the ingredients you need with instructions and whatever. Unique things like that I thought were pretty cool. And obviously that type of interface, cooking is a very basic example, but that could be used for many, many things in life, as you might imagine. So very interesting. It's very early stages for Firefox's browser, but definitely looks promising. And finally, speaking of startups raising a ton of money, the startup Wayray raised $80 million. It was led by Porsche, the car company, actually. And so what Wayray does is they create holographic heads-up displays, HUDs, that can be used on car windshields or regular windows. Obviously, in this case, Porsche is investing for the windshield case. But they have unique holographic projection technology that could be very valuable in the future. We'll have to see, but I've seen some of their demos. They look very cool. Obviously, a lot of these AR demos look much cooler online than they often end up being in real life, but certainly interesting that Porsche was willing to fork up a huge amount of capital. They must have seen some type of promising technology there. Anyways, that's kind of the AR update for the week. Thank you guys so much for listening. I hope you enjoyed. If you did, please leave a review on whatever podcast platform that you listen to. Share this with one person who you think would also enjoy. Just one. Email it to them, text it to them, whatever. Share it publicly if you want. Tweet it out to the world. It doesn't matter. I would very much appreciate it. Anyways, thank you guys so much for listening. See you next time.